So we're looking at the 7 goals that your economy might have. And so we looked at the first one, which was improving the standard of living. Our second goal was economic growth. Our third one was full employment. Our fourth goal was stable prices. Okay, and we're now on to our fifth goal, which is the balance of international trade. So when we look at the balance of international trade, we are looking at the difference between what our country exports and what we import. Okay, so let's look first at what it means to export. Exports are the goods and services that are sold to other countries. So we make them here and we sell them to people or companies or other governments, but people in other countries. So when we have exports, the goods and services are leaving and the money is coming in to our country. Okay? Then we have imports. Imports are where the goods and services are made by people in other countries and they're brought in to our country. So in that case, the goods and services are coming in and our money is going out. So when we talk about the balance of trade, we're talking about exports compared to imports. So if we take exports minus imports, we can see what's happening with our balance of trade. We have a trade surplus if our exports are more than our imports. So a trade surplus means that we're selling more goods to other countries, so lots of money's coming into us, than we are buying from other countries. So there's more money coming in than going out. A trade deficit is where we import, so we're bringing in more goods from other countries than we're selling to them. So with a trade deficit, there's more money going out. When we talk about measuring the size of our economy, GDP, part of measuring GDP is going to be exports minus imports. So the balance of trade is going to impact economic growth. A trade surplus brings more money into our economy and can add to that economic growth. A trade deficit is money going out. Okay, so if we buy more from other countries than people buy from ours, that will impact the size of our economy. All right, so let's look at what we export and import. So we import, number one thing we import is consumer goods, followed by automotive products. And here you see exports. The primary thing we export is energy products, followed by automotive products. What do you notice? Notice that those things on the list, automotive products, are the same. Consumer goods are the same. And that's because we specialize and we trade. So, for example, the Toyota Corolla is made in Canada. The Camry is made in the US. Well, if you live in Canada, you have lots of different Toyota products to choose from. Some of them made here, some of them made in the US. If you're in the US, you have lots of choices for Toyota products as well. So we specialize and we trade. Parts, okay, so if we look at making a vehicle, many vehicles that are made in North America, parts come from Mexico, US, and Canada. Assembly, depending on which line of vehicle it is made in different places, but then we have access to all of those choices. So we export and import a lot of the same products, just different models, different brands, but you can see it's a lot of the same things that are going in and out. When we look at who we import from, so who we buy the most goods from, we buy most of our goods from the US. Notice that our imports from China are about 8% compared to about 64% from the US. All right, who do we sell most of our goods to? Well, we sell most of our goods to the US as well. You see about 75% of the goods we sell to other countries go to the US. So you can see that we buy and sell a lot of goods between Canada and the US. So that's why when the US economy has a recession, the Canadian economy has a recession. They're very closely tied together because of the international trade. If we look at Alberta, Alberta has an even closer tie to the US. If we look at exports for Alberta, about 85% of the exports, so the goods and services that we make in Alberta that we sell to other countries, 85% of them go to the US. In comparison, Manitoba is about 67%. So Alberta is the most reliant on trade with the US. In fact, about 13% of Alberta jobs are tied to trade with the US. And so Alberta is very reliant on what's happening with the Canadian US dollar exchange rate, with what's happening in the US economy, because we sell so much of our products to them. All right, so how do we get a balance of international trade? Well, we adjust the imports or the exports. So exports go up or imports go down. That will get you closer to a trade surplus. Now, the challenge, though, with achieving a balance of international trade is that surpluses and deficits can affect the exchange rate, just as the exchange rate affects trade surpluses and deficits. As well, trade surpluses and deficits can affect interest rates. So let's break this down a bit. All right, so let's look here at what happens if we have a surplus or a deficit, what happens to exchange rates. But first, let's look at what is the exchange rate. So if we go to the Bank of Canada, we can see the US-Canada exchange rate. So 1 Canadian dollar is equal to 75 cents US. 1 US dollar is equal to 1.33 Canadian. So they're just the inverse. So 1 divided by 0.75 is equal to 1.33. All right, so let's go back. So right now, 1 Canadian dollar is equal to 75 cents US. And that means 1 US dollar is equal to 1 divided by 0.75. Right, that's that 1.33 Canadian. So if you had 1 US dollar, it would buy $1.33 worth of Canadian goods. And if you had 1 Canadian dollar, it would buy 75 cents worth of US goods. All right, so how does a trade surplus or a deficit change the exchange rate? All right, so let's suppose that our exports are less than our imports. If our exports are less than our imports, do we have a trade surplus or a trade deficit? We have a trade deficit, because imports is money going out, goods coming in. Exports, goods going out, money coming in. So if we're buying more goods from other countries than they're buying from us, the money's going out, and we have a trade deficit. Well, if we have a trade deficit, then that means that the rest of the world, right, holds our money. And what's the point? So let's say that you're in the US and you have a bunch of Canadian money. What's the point of Canadian money in the US? It's not like you can go into Walmart in Texas and pay them in Canadian dollars. The only use of Canadian money is to buy Canadian stuff, invest in Canadian stock markets, right? The only people that have use of Canadian money are Canadians. So if we have a trade deficit, then that means the rest of the world has a lot of Canadian dollars. Well, what do they do with that money? Well, the only thing they can do with it is use it within Canada. So that's going to start to change the exchange rate, because Well, it's a supply and a demand issue, right? So here we go. The rest of the world has our money, demand, supply. This is the world market for Canadian dollars. There's a lot of supply of Canadian dollars out in the rest of the world. Okay. And anytime you have an increase in supply, what does that do to the price? Makes it go down. Well, in this terms, it's the value of the Canadian dollar. It's going to make the Canadian dollar go down in value because there's a lot of Canadian money out there in the rest of the world. Now, trade surpluses and deficits also affect interest rates. Okay, so let's suppose we have that same trade deficit. The rest of the world is holding your money. If the rest of the world is holding your money, right, they got to do something with it. And they can buy your stuff or they can invest in your stock market. So if they all have a bunch of your money and they decide they want to invest in Canadian dollars, well, that means there's a lot of people now. So they're going to invest in Canadian dollars. So they're going to invest in our stock market. Let's just reword that. So they're going to invest all those Canadian dollars in the stock market. They got to do something with all that extra Canadian dollars. Well, what does that mean? That means that there's now a lot of people who essentially want to loan Canadian money. Okay, so if we think about bonds, bonds are basically debt, an IOU, right? You're borrowing money from someone and in return you're going to pay them interest, right? Stocks, that's a way to raise money. So someone is essentially lending you money when they invest in the stock market. So what happens is there's now lots of Canadian money coming in from all those foreign countries because they had it from our trade deficit, which means if there's a lot of people willing to lend you money, who do you borrow from? You borrow from whomever is the cheapest. And so trade deficits can drive Canadian interest rates down. They drive down the Canadian dollar as well, as all of that Canadian dollars live out in the rest of the world. And the only thing you can do with that Canadian money is put it back into the Canadian economy in terms of goods or investing in our stocks and bonds. Okay, so we'll look more at those relationships later on in the semester. Right now, we simply want to focus on what is happening with our balance of trade. Okay, well, here's our exports and imports over time. And so currently, where are we in terms of our balance of trade? We can see that throughout the 60s, exports were more than imports, as well as the 70s and 80s. So we had a long period of trade surplus. And then as we look into the 2000s, we can see a period here where we have a trade deficit. Here's trade surpluses. And lately, we've been going back and forth between trade deficits and trade surpluses. So to figure out exactly where we are right now, we go to Stats Canada, and we do our more key indicators, and you can see our trade balance right here. So as of June 2019, that number is positive, which means exports are more than imports, and we have a trade surplus. If we go further back in time, we've had deficits in the last 2 years as well. It seems to kind of go back and forth as we're very close to that balance of trade. The US, on the other hand, has had a trade deficit for a very long time. And you can see that trade deficit got bigger and bigger and bigger. Some economists blame this increasing trade deficit on the 2008 recession. For more information on how a prolonged trade deficit can lead to economic problems such as a recession, check out the next video. If we look at exports, we can see that China is the #1 exporter in terms of the value of goods that they sell to other countries. They moved to the #1 place in 2009, exporting $2 trillion worth of goods in US dollars. Canada falls into 11th place, and US is in second place.